Welcome to the daily update, where I'll go over the action in the market for Tuesday, June 4th, and then we'll see how things look for Wednesday, June 5th. We had another one of those days where we started off weak and then saw a more solid advance going into the close. That's keeping a lot of our indicators still positive, but we're still seeing some weakness coming through a lot of our different indicators. So we're still seeing a mixed environment when we look at everything taken all together. We're above moving averages, but especially in the intermediate term, we're starting to see weakness just continue, but our smart money indicators are still looking positive. However, we're not trending right now, so it's not a real surprise that we're seeing real mixed signals as we're going into this. Before I start, please be aware that the SPX Investing Program has launched. It launched on Monday, June 3rd. It's free for the month of June. Here is the link right here. It's also in the description below this video. If you want to send me an email, here's an email address where I can be contacted. If you have questions, if you want to set up a time to talk, either using video or voice, that is just fine if you want to do that. Then, going back and talking about what happened right at the open, we did have a lower open. The futures were pretty negative during the night. We opened right about at the daily pivot, which was lower at 52.73. And then we drifted lower and we found support right around the 52.90 level. As the day went on, this is when we started to see a rainbow, not a rainbow, a rebound. Yeah, I guess it's been raining a lot where I'm at right now. And we went back above the daily pivot and the unchanged level, and we closed positive, but still below that 5,300 level. We were up 0.15% below average with volume. We are mixed actually, we're leaning a little more positive in the short term. It's the intermediate term where we're more mixed. We're still positive in the long term, and it's about inflation and interest rates. Interest rates have really been coming down. If we're seeing any strength out of stocks right now, it's getting support from interest rates headed lower. But we're going to get the big employment situation report on Friday. And then we want to be aware of all the different things going on in the world that sometimes can have an impact on the market. Some comments, we saw another late day bounce from session lows. This time it was led by mega caps. They actually outperformed. On a short-term basis, we only have our stochastics that are right now looking extreme positive. And then the 200 period simple moving average, it's back above that extreme reading. It's been there for most of 2024. It fell off briefly, but now has come back on the list. I've added one thing to the scenario. The Fed is keeping rates higher for longer because inflation has not been coming down. Now there's some economic growth concerns starting to come back into the market. This is where bad news may end up being bad news. And maybe we'll get some direction from that on Friday with the employment situation report. And this is starting to worry the market. For a while, bad news was good news. And then good news was bad news. We're seeing that shift starting to take place. The dollar was down and interest rates were also down. We closed at 4.34% with the 10-year yield, where we had been at 4.41%. So this coming down is really giving some support to stocks right now as far as the 10-year yield. We're still inverted with the yield curves. We're negative now. We actually shifted down to 41 with sentiment, where we had been at neutral at 48. We're still not trending. We are negative. The red line is on top. This is one of the more intermediate term indicators that shows that we're seeing that mixed picture. And the ADX is still below its moving average, and it's still below 20. We are positive with the bias because we've had two slight up days. And the momentum, I'm keeping it mixed right now. You could probably lean that over to positive. It's been quite positive to see weaker opens and then a stronger close. But our indicators are just making us feel a little uncomfortable right now. We did get factory orders. They came in up 0.7%, more than the 0.6% that they thought was going to come out, and 0.7 is what we saw last time. The JOLTS job openings, this was the big one, and these are declining. That means there's fewer jobs available. This is part of the growth concerns. We were at 11 million, then 10 million, down to 9 million. Now we're getting down into the 8 millions. We came in at 8.059 million. Last time it was 8.355 million. Here's a chart of the factory orders year over year. We are slightly above zero, so we're somewhat positive that way. Durable goods year over year, slightly above zero. The non-durable goods year over year, a little bit more above zero. Non-defense capital goods, when you take out aircraft year over year, slightly above zero. Non-defense capital goods, when you take out aircraft as well. Okay, I guess we're seeing the same chart twice here. So and this must have been really important here, slightly above zero. And then the job openings are starting to trail off here based on the last few readings that we've seen. They were stronger and we started to get weaker, and then we've seen this gradual tapering off. And this is what the Fed is keeping an eye on. If the job openings go down and unemployment goes up, that may give them more reason to cut rates, but that could also mean that the economy is starting to show some weakness. Here's some IsabelNet blog charts. More reasons for bulls to run. This is when we're greater than 10% by the end of May. This is looking out where we see the June return is usually up 1%. For the rest of the year, we're up 8.8%. The median is 1.8% on a month-over-month basis and 8.8%. And we're up 84% of the time. By the end of the year, we're up the following month, now June, 68.4% of the time. Then here's the heavy truck sales. They are still going up. So if we're seeing some economic weakness, it's not really being seen right here. Then small caps, they've outperformed other parts of the stock market, at least historically. That's not what's happening now. The yellow line are how small caps generally do, because they quite often will have lower stock prices. So if they go from 10 to 20, that's 100% return. Where if you have a bigger stock that it has a higher share price that it goes from 100 to 110. Well, they both climbed 10 points, but one has climbed 100%, the other one has climbed 10%. So that's historically what has happened. Here's the mid caps and then the large caps. We're seeing just a flip-flop of that right now in 2024, and we have been for the last few years. And then US ISM Manufacturing Index against the S&P. Purple is the S&P, where it has it going up, where we're seeing the ISM manufacturing coming down and actually dropping below 50. This is part of the concern that the market is starting to adopt, that we're seeing manufacturing trailing off since we're below 50. That shows a contraction. Then hedge funds and mutual funds have increased exposure to equities, where we have the dark blue line here. This is hedge fund exposure at 76%. Now, some of you that don't know what hedge funds are, they're like mutual funds, but they usually charge a lot more. They have requirements for who can get into those, and they're supposed to have some rock star manager that really knows what they're doing. Sometimes that works out, sometimes they don't. Like, I can't remember the name of the guy. It's not Jamie Dimon. He's the CEO of JP Morgan. Anyway, all right. And then we've seen 1.4% increase as far as equity mutual funds as a cash percent of assets. And then which asset class do you expect to perform the best over the next 3 months? This is developing markets. That's the US, that's Western Europe. Where emerging markets, those are other countries, and they see developing markets doing the best. A lot of folks really like to do the emerging markets play. It looked like at the beginning of 2023, not 2024, that was going to be a good thing, but it just kind of fizzled out. It was like the January effect for small caps this past January. That just kind of fizzled out too, where then we have government bonds, emerging market bonds, developing market credit, and then cash. A lot of people are still in cash. So a lot of folks are either in money markets, or if they are into the stock market, they're in the more developed countries, specifically the US and Western Europe. I didn't find anything on Twitter. I was dealing with an internet outage that lasted all night and well into the morning. And when I get ready to prepare this video, I'm way behind where I usually am. So I didn't waste my time on Twitter. Here's our intraday chart where we did have a lower open. We opened at the daily pivot and then drifted lower. We found some support, and then we were able to bounce back above the daily pivot, get above the unchanged level, went negative slightly, but then bounced up and closed a little bit positive on the day. Here's our intraday chart, really not showing us too much. We did see a real drop off here in the futures as things were getting more negative, but then the gradual climb back up, and we're slightly positive to a bit unchanged in the initial overnight session. We are still looking positive here. We're seeing the blue line above the red line. On an intraday basis, large cap growth is outperforming large cap value. And we're looking okay here with our S&P growth to value ratio. We were slightly positive as growth outperformed intraday. And we were up with large cap growth where large cap value was down. We were down more with the mid caps and down more with the small caps. So Tuesday's session was pretty much a large cap growth event. So we're not really seeing any improvements here with our small cap growth to value ratio and our mid cap growth to value ratio not really improving. A little bit of a tick up even with our S&P growth to value ratio. These areas we want to see doing better than what they have been, and they're just not doing it right now. Here's our ETF growth versus value. It ticked back up. It had come just about down to the top of the rainbow before it saw a bounce up on Tuesday. And we're not really seeing much of an improvement here. Discretionary to staples, we actually declined. We want to see this do better than what it has been. Large cap growth, though, is still holding up. It was up and well above its 50-day moving average. The Wilshire, which it's kind of looking like we may have bounced off that 50-day moving average with this index. This is the one that we really only hit last week. The other ones we just kind of got close, like with the S&P, but it was virtually unchanged in Tuesday's session, and it was little changed in Monday's session. We just are seeing a lot of gyration only to close near the unchanged level. Here's our trend showing that the ADX is going down. It's below 20. It's below its moving average. That suggests that we're in a weakening trend, but it's not even a trend. It's a non-trending environment. We are negative. Even though the red line is declining, it's still on top. We're seeing that same thing here with our shorter term chart, where we're below the moving average and the red line is on top, but it is declining. Volume really dropped off again when we look at our oscillator. It's gone back to being below average both in Monday and Tuesday's session. Sentiment is pretty much sideways, still below the moving average with the Ulcer Index. We haven't had the latest reading from Investors Intelligence. We ticked back up on a closing basis with the VIX. We're getting a little bit higher here, and we closed well off of the highs because this was going up as the market was going down, and then this was going down as the market was going up. And we're showing with the close here, volatility of the VIX is starting to drop off and we're below the moving averages, both with the bar chart and the line chart. But the momentum of the VIX continues to be up as we've been seeing some downward movement lately. Equity put call ratio ticked up just slightly, and now we're switching yet again. We're now going up with the equity put call ratio. When this is going up, that tends to be more positive for stocks. When it's going down, that tends to be more negative for stocks. Volatility risk premium still fairly high. We came down to the band and now we're bouncing back up a little bit. So we're seeing a bit of an increase in volatility that from some viewpoints, you may be able to get more if you sell options. It may cost you more if you're looking to buy options. This fear gauge did drop off, but our other fear gauge went up. So we're seeing a discrepancy there. This is a little bit of a concern. We had an update with the S&P, but we were down based on price and volume. We're still well above the moving averages, but you can see just not a lot of conviction in Tuesday's session. And we dropped off, but we're still seeing more highs than new lows right now. We're still negative, but turning up with our 5 period. We continue to decline with the 10 period. And we're kind of right in between here. We have the blue line slightly negative. That's the shorter term advanced decline ratio, where the red line is the more intermediate term advanced decline ratio. That's slightly positive. This is what's also positive right now. The accumulation distribution continues to advance above a rising moving average. This is one of our smart money indicators. The Chaikin money flow trailed off a little bit, but the moving average still continues to go up. Another smart money indicator. The Chaikin oscillator continues to go up. Another smart money indicator. We came down with the cumulative NYSE advanced decline line back down to the 50-day moving average, where we ticked down just slightly with our regular NYSE advanced decline line. Also ticked down, but above the 50-day moving average with our other NYSE advanced decline line. We came down with the NYSE common stock based on price. We also declined based on volume. With the S&P cumulative price, we ticked down just barely, and we ticked down even less here with volume. So this is somewhat encouraging. We're seeing volume right now holding up better than we are price. We're seeing some weakness here in the advanced decline line studies with the NYSE common stock, S&P, mid caps, and small caps, but each one of these are still above their moving averages. Here's our daily chart. Not really anything significant right now. We might have some of these pivot points to mess around with, but they're not really all that far apart from each other. So this is still looking more positive. We've now spent the last 2 trading sessions below average with volume. We're coming up and looking a little more positive in the short term with our stochastics, turning back up in the intermediate short term. We're still extreme positive in the long short term. We're still below our double and triple exponential moving averages based on 20 periods. It would be more positive if we could get above that. These may be acting as overhead resistance. We're ticking down, even though we had an up day with the S&P, we're going down with the 20, 50, and we're pretty much flat with the 200 period moving average study. We're still positive with the force index. We're still above the 20 period moving averages. That's short-term positive. We're still above the midpoint with our standard deviations channel. That's positive. We're right on 0 with the balance of power. That's neutral. We're still positive with the go, no go system with the darker blue bars. We're above the midpoint with the highest high chart. We're still declining in dark blue with the TTM squeeze. And we're right inside of our double and triple exponential moving average study based on 50 periods. This is also showing a more mixed environment currently. We're above the 50 period moving averages. We'll watch those if we see weakness to see if they offer support. We're positive with the ease of movement, and we're pretty much flat, but still positive with the Arun indicator. We're negative with the S&P McClellan oscillator. We're below 0 and declining. That means the summation index based on price and volume continue to decline. We're also negative in a broader market sense with the NYSE McClellan oscillator below 0. So the summation index for the NYSE based on price and volume are declining. This is still negative, but showing some improvement. The Swenlin trading oscillator is going up, both based on price and volume. We're just slightly negative with volume. If we could cross back above 0, this would be more of a positive signal. Momentum, not really doing all that much right now because the market hasn't been doing all that much. The PMO is right on top of its moving average where we're still negative based on price and volume. Not really much of a change here with the PMOs that are rising. We're flat with the buy signals. We're slightly declining with the PMOs that are above 0. We've gone from being neutral back over to positive with the Elder's Impulse system. We're still negative with the parabolic SAR. The slope continues to decline. The MACD continues to decline. So we're looking more negative on a momentum basis in the short term, now more in the intermediate term. We're not quite below the moving average with the tricks, but we're right on top of the moving average with the KST, turning negative. We're above all the plotted moving averages, though. The bullish percent index is still positive, but it's declining. It's positive because it's above 50. It's negative because it has been declining lately. The NYSE bullish percent index is also declining, but still above 50. We're negative with the NASDAQ 100 bullish percent index. We're below 50 and declining. The money flow is still positive. The ultimate oscillator continues to be positive. The vortex is positive. We have the green line coming down to the red line and then bouncing back up. So that's positive. We're still looking okay with the RSI 14. We're up into the 50 range as well as the 9 period range with the RSI 14 and the RSI 9. On balance volume continues to be positive. We're still negative looking at our 20 period moving averages in the S&P. We're below 50 and declining. Here's our study, wondering if we're going to still see more follow through to this initial up thrust. The 50 period moving average study is also negative since it's below 50 and declining. We're above 50, but declining with our 100 period moving average study, and we're declining and way above 50 with our 200 period moving average study. The Copic curve, another momentum oscillator, is negative. The Sean trend meter is actually going up and not quite extreme positive. We're a little bit above the mini rainbow here. So far, we're looking a little more positive according to this chart. We're still looking okay with the Heiken Ashi. That's looking better with the open candle. The Kegi is black and pointing up. That's positive. The Renko is positive, and the 3-line break is positive. And I put the 200 period moving average study back on the list because we're slightly above this red line. We're no longer extreme with the 150 moving average study. And I think we started a new cycle on June 4th. So now this begins a new 50-day cycle. Again, I use these more for informational purposes. I would like to be able to use cycles in a more definitive manner, but it seems like once you find one, they end up falling apart fairly quickly. We have not seen a confirmation signal with the Hindenburg omen yet. We're seeing a little bit of an improvement here where we're negative with the mid caps and the small caps, but we're seeing some improvement across the different indexes according to the Keller market model. Also, we're looking a little more positive with the bonds based on price. We're now positive in the short and intermediate term, where we're still negative with commodities and the US dollar in the short term. No changes with the decision point scorecard. We saw it mostly negative. Canada was having a little trouble. The NASDAQ crossed below 16.8. We had a NASDAQ BPI cross below 50. Now, the NASDAQ 100 BPI, that's already crossed below 50. I don't track the NASDAQ BPI. And then communications. This is one of the stronger areas. It set a 2-year high. Looking at our different sectors, real estate saw some love, followed by staples. That's a little bit of a concern to us, but communication, that's more growth. Healthcare is also another defensive area. And then tech was also up. Discretionary was virtually unchanged, but a little bit positive. Industrials were, utilities and industrials were down. Financials, energy, and materials were also down. So we did see, looking at our next chart here, we came back up with the ratio showing that the mega caps did outperform. The Dow is still below its 50-day moving average and still below this pivot point, even though it was up over 1/3%. The diamonds still remain neutral for the Elder's Impulse system. The NASDAQ not really hitting any overhead resistance, not really seeing any support at the current time. It was up slightly. The NASDAQ 100 also kind of in no man's land, according to this chart for right now, but still maintaining a positive stance. The Qs still remain neutral for the Elder's Impulse system, but the momentum for the NASDAQ 100 is now changed to negative. But when we look at moving averages, the Qs are still above the 20, 50, and 200 period moving averages here. Small caps, of course, they had to be down. They got a little too high up into their range, and so they're coming down to their 50-day moving average. And then we're turning or staying negative with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, we're dropping below 50 with the RSI. We dropped below the 50-day moving average, and the momentum is negative. The mid caps also saw some weakness, down over 1.33%. We'd like to see some more strength in this area to turn more positive. And we've turned from neutral to negative for the mid caps when looking at the Elder's Impulse system. Apple was barely up, and the longer it can stay above these lines, the more it might see a golden cross on a longer term trend. Tesla was down and still dealing with its 50-day moving average, still in a downtrend. Nvidia was up over 1%, still everybody's darling stock right now. Microsoft was up, coming back up to its 50-day moving average. Meta having a hard time getting above its 50-day moving average. Amazon still below its 50-day moving average. Google was up and is above its 50-day moving average and looking a little bit stronger. Netflix still above its 50-day moving average and in a longer-term uptrend. The FANG index was up 0.25%, longer-term uptrend above its 50-day moving average. So the market's hanging in there. We're just not seeing an awful lot of conviction. We were down slightly with the financial sector, coming right back down to about its 50-day moving average. We're seeing this ratio going up. That means staples are outperforming tech. We want to see this ratio going down to be more positive. The dollar was up, and it's still in an uptrend, according to how I measure trends. And we look at the correlation between the S&P and the world index. It's kind of not really changing all that much with our shorter term correlation or our longer term correlation. The staples sector, it was up 0.84%. This is giving us some concern. If we're going to see economic weakness, we would probably see the staples continue to go up. This might turn the stock market more defensive. Utilities were virtually unchanged, down just a little bit, but still have been really strong lately. Another defensive area. Healthcare was up above its 50-day moving average, another defensive area. Energy ended up being down 0.95%. Not sure if that's defensive or not currently. When we look at the total U.S. stock ETF, we were virtually unchanged, but we're still above the 50-day moving average. We were down with the 10-year yield. We're dropping below the 200-day moving average. We were up with the 10-year based on price, and that could be giving support to stocks. With our growth to value ratios, not much of an improvement with the Qs to the S&P. Still seeing weakness with discretionary to the S&P. Bounce back up when we compare large cap growth to large cap value. So a bit of an improvement with the large caps, a little bit of a turn up. It's still negative with the mid caps and the small caps. We're still slightly negative here. At least we dropped down from being extreme positive into this still positive area, but well off of the high reading we had been getting with our 10-day average of the S&P 500 highs minus the lows. We're just barely positive with our advanced decline ratio based on price, and we're slightly positive based on volume. This is another area where volume appears to be slightly outperforming price currently. The S&P to utilities ratio hasn't really been moving all that much lately. We want to see this go up to be more positive. We came up with the Staples to S&P 500 ratio. We want to see this going down to be more positive. So what's our outlook for Wednesday? We're still positive, but we're getting mixed signals. There's still weakness that could be coming into the market. Now, for Wednesday's session, we don't have positive seasonality just for that day. But when you look at it during an election year and you take it in the bigger context, we do have positive seasonality. We're going to get the MBNA Mortgage Applications Index, the ADP Employment Change, the S&P Global U.S. Services. We got the manufacturing on Monday. Now we're going to get the services report. This is the big one, the ISM non-manufacturing, or you could say services. And then we want to keep an eye on all the crazy things going on. So then on Thursday, we're going to get weekly jobless claims and productivity and unit labor costs. That can be rather influential. The big one is going to be on Friday with the employment situation report. And here's just a look at the previous readings, and then if there was a forecast for the readings of the economic reports coming out on Wednesday. This is seasonality. When we just take June 5th, going from 2002 to 2022, we're negative with the Dow, neutral to negative with the S&P and NASDAQ. Wednesday did not perform very well in 2023. It's the most negative day of the week. But when we look at this chart, looking at June 5th, we see the green dashed line actually going up and continuing to go up until we get about to the 10th of June. And looking at this chart, we also may see some positive seasonality. If you don't count 2020, just kind of throw that away like it never even happened. This is what has happened when you have the sitting president running for re-election. This also shows for the NASDAQ, where we might see a bit of choppiness here for the NASDAQ, and then we might see a little more strength coming into July, and then ahead of the conventions, the political conventions, we might see some weakness. Here's Tom Bowley's research. June tends to underperform, where we're in that positive time right now. Then we go into a negative time, then a positive time, negative time, and then we finish out with a more positive time, according to his research. So the warning signs, we're still wondering in the back of our minds. Now, we haven't set an all-time high now in a while with the S&P, but when we did set that all-time high, staples and utilities were really strong, and that's still a warning sign that we're keeping in the back of our minds here. We're watching energy and healthcare, especially healthcare. Growth of value and discretionary to staples, they're not showing any strength right now. They're not leading the market higher. The equity put call ratio, it had been going down. Now it's going back up. And the S&P and the NYSE McClellan oscillators, as well as summation indexes, are negative. Our oscillators are turning negative, not quite as much in the long term, but we're seeing it more in the short and intermediate term. The Swenlin trading oscillator, it's negative, but it is coming back up. That could eventually get over to the positive side if we see follow through. The parabolic SAR, a primary indicator, is negative. The Copic curve is negative. The 20 and 50 period moving average studies, they are negative. Bullish percent index for the NASDAQ 100 is negative, and the momentum for the NASDAQ 100 is also negative. Then our positive signs, the advanced decline lines, they're still above their moving averages, but they are showing some weakness. We do have a lot of positive indicators, even though a lot of them are declining right now. The bullish percent index, another primary indicator, it's still above 50, but it's declining. Accumulation distribution, that's one of the more encouraging things we're seeing, as well as the Chaikin money flow and the Chaikin oscillator. The money flow and the ultimate oscillator are both positive. The vortex, another primary indicator, is going back up, and the financial sector still is positive. So our conclusion, this is the same. We're positive, but we're getting some mixed signals. We're seeing some weakness coming in. We're not in a trending environment. We do have positive seasonality in the bigger picture, but for Wednesday's session, we really don't. So in the short term, we are positive, but we do see some weakness developing with positive seasonality. We see more of that weakness really starting to develop in the intermediate term, where we're still positive in the long term. Thank you. I really hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.